Hey guys, welcome to Market Mondays. Hopefully, you guys had a great weekend. I actually won my first tennis match for the year, which is a lot better than I did last year because I didn't win a single match until the summer. So, I'm doing a lot better already. So, pretty much can already start this year out with the bang. Getting tired of getting beat by a bunch of old dudes and 12-year-olds. Anyway, so last week we saw a bit of a spike in mortgage rates, and the reason why that happened is because of how the jobs report came out. So before I get right into it, I'm gonna do a quick dad joke for you guys. So why does the toilet win at poker every single time? Why does the toilet win at poker at every single time? It's because it always has flush. It always has flush. Pew, pew. All right, so getting right into it. Last week, all the jobs reports came out. The BLS, ADP, the unemployment rate, all that stuff. Basically, what the numbers superficially showed was that the numbers were showing the jobs market still being relatively hot. Now, if you dive deeper into the numbers, what's interesting is that full-time workers basically declined. Full-time workers, those basically 36 to 40 hours a week, declined. Well, and the tough thing is that what the number that did show the spike showing the higher job openings and stuff like that is because of due to part-time workers. So part-time workers between the age of 16 and 19 and 55 and plus showed a drastic hundreds of extra, a few hundred thousand extra employees in those sectors. Now, what's nice to the superficial numbers is that the jobs market looks strong. That's what it looks like. So if the jobs market looks strong, then that's a sign of our economy doing well. Because if you really think about it, in the grand scheme of things, in the overall view, if you're looking at it from that perspective, is that our inflation has come down to less than 3% on most of the reports. Right? Last year was in the almost 10%. 7 to 10%. That was what inflation was at. Oh, and since last year, it's come down to less than 3, which is really, really good. So now we have a low inflation number and a strong jobs market. That's essentially what investors see. So because we have still a remaining jobs market, that caused a lot of investors to feel like our economy is strong, therefore put money more in stocks, sell the mortgage-backed securities. Selling mortgage-backed securities causes rates to go up. That's essentially how that works. So, but if you look, again, if we dive deeper into the numbers, it just showed that a lot of part-time workers into the business. Now, why is this a big deal? Well, the thing with part-time workers is that when you have a part-time employee, especially if you do or do not offer benefits as a company, is that as a part-time worker, you don't have to offer benefits, health benefits, dental benefits, 401k, stuff like that. You don't have to offer those things. So it's more cost-effective to have a part-time worker than it is to have a full-time worker in the sense of where we're at now. So a lot of people have either come down to or started part-time. Now, a lot of the full-time workers, if you really look at the numbers into the report, is that it showed that a lot of the people have left the full-time the sector and a lot more gained in the part-time worker area. And the other thing is that the people who have remained jobless for more than 5 weeks have remained jobless, and that number has gone up, the amount of people who are jobless. So it's kind of like a skewed number. It's kind of not true as to how our jobs market actually is, except the superficial numbers that jobs report shows that jobs market is strong. Even the unemployment rate is 0.1% better, but that's only coming from the household survey. So that's what's unfortunate and tough about how rates are reacting to what the jobs market is doing. So they've done all they can with the reaction to the inflation reports, and honestly, inflation has come down so much to the point where it's getting to the point where it's going to plateau at the bottom. So it's really not much movement, or it's not going to move drastically as it had in the last year. So really the only other question is how the job market is going to go. So it sucks, and it's weird to say this, that the worse the job market is doing, the better mortgage rates are going to get. And that's essentially what we saw last November. And why rates need to come. The only way rates are going to come down is like a cooler jobs market. That's essentially what's going to be needed. So that's essentially it. So to give you guys an idea of how that looks, as far as what rates have done in the last week, you can kind of see this gigantic spike from the bottom here where it kind of dipped down and went back up. You can see conventional rates are a little bit higher, not by much, but we're still in the low 7s, high 6s. So it's really fluctuating between the 7% marker. And that's kind of what we're seeing with mortgage rates, is that it's effectively plateaued over since the start of the year, which I'll say it's a nice change from the volatility that we saw last year. So things are looking ish better in comparison to last year, but for the most part, it's really tough to say that the only thing that's keeping mortgage rates as high as they are is that people have jobs. Because if people have jobs, then they can afford the higher rates, right? I don't know about that, but that's essentially what's causing rates to be as high as they are and maintained as high as they are. Anyway, hopefully that gave you guys some insight as to what rates are doing. Otherwise, that's all I got for you guys today. Hopefully you guys have a great week, and I will talk to you guys on VA Fridays this Friday. Anyway, that's all I got.